Hello traders, let us take a look on how the gross domestic product (GDP) of a country affects its currency as seen in the financial markets and forex market in particular. Kindly remember to like and subscribe. The global economy is an intricate web of interconnected factors that influence each other in profound ways, as we will see. Among these factors, the GDP and the value of a country's currency stand out as two vital elements that play a significant role in shaping a nation's economic landscape. The relationship between GDP and currency value is a versatile one, involving intricate dynamics influenced by domestic and international forces. This video delves into the complex relationship between the GDP and currency value as we try to enlighten you on how changes in GDP can impact the strength of a given currency, including the dollar, euro, yen, and pound, among others. Typically, the GDP serves as a crucial indicator of a country's economic health. It reflects a nation's economic output and growth potential. The currency value, on the other hand, refers to the worth of a country's currency in relation to other currencies in the international market. The relationship between GDP and currency value is not one-dimensional, but rather a complex interplay that involves both short-term and long-term effects. While it is commonly believed that a higher GDP should result in a stronger currency, the reality is more delicate than perceived. As usual, we lay our focus on some of the instrumental areas where the gross domestic product exerts impacts that directly affect the value of a currency and its movement, including interest rate and inflation, trade balances, investor confidence, the capital outflows, market expectations, and political stability. So, let's look at interest rate and inflation. Typically, a country's central bank uses interest rates as a tool to manage inflation and promote economic stability. When a nation experiences strong GDP growth, it often translates to increased consumer spending and demand for goods and services. This rise in demand can lead to higher inflation rates if supply struggles to keep up. To counter this or to control this, central banks might decide to raise interest rates, making borrowing more expensive and restricting excessive spending. As a result, higher interest rates attract foreign investors who are seeking better returns on their investments. The allure of higher yields on bonds and other financial instruments denominated in the domestic currency usually lead to increased demand for that currency. As foreign investors exchange their currencies for the domestic currency to make this investment, the increased demand can contribute to the appreciation of the given currency. The other area is on trade balances, where we see that the GDP growth often goes hand in hand with increased export activity. A country's economy tends to have more goods and services available for export, thereby leading to a positive trade balance where exports exceed the imports. On the other hand, when a country's export exceeds imports, it means that more foreign currency is flown into the country than leaving it. This usually leads to an increased demand for domestic currency, as foreign buyers need to convert their currencies to the local currency to purchase the exported goods and services. This creates a favorable trade balance. A favorable trade balance and robust export activity can contribute to the strength of a currency. However, it is worth noting that Other factors, including but not limited to import demand, trade agreements, and currency manipulation by other countries, can also influence trade balances and the value of currency or currencies. So, how does GDP affect the investor confidence? It is worth noting that a high GDP growth is often seen as a sign of healthy and vibrant economy. A nation that demonstrates consistent growth is likely to have a stable economic environment with abundant opportunities for both domestic and foreign investors. This creates a positive perception which can significantly enhance or does significantly enhance investor confidence. Investor confidence matters because it affects capital flows. Foreign investors seeking reliable and profitable investment opportunities are more likely to invest in countries with strong economic fundamentals. When these investors pour capital into the country, they usually convert their currencies into the local currency, thereby increasing its demand and consequently its value in the foreign exchange market. So you will see a given currency rising when its GDP is doing good. The other area we are looking at, or that is affected by GDP, is the capital flows. Countries expanding, or rather, countries experiencing rapid GDP growth often attract significant capital inflows from foreign investors, as we have seen. These investors are usually drawn to the potential for high returns that a growing economy usually provide. As they invest in various sectors such as stock, real estate, and other businesses, they typically need to exchange their currencies for the domestic currency, which results in increase in its demand. The increased demand for the domestic currency driven by capital inflows usually contributes to currency appreciation as more investors and buyers see opportunities to buy the currency as it appreciates. However, sudden shifts in investor sentiment or changes in global economic conditions can lead to rapid capital outflows, potentially putting downward pressure on the currency's value. So with all this happening, it is also good to look at what market participants are doing depending on the expectations of the market as a result of GDP numbers. Typically, you'll see that market participants, that is investors, traders, speculators, and others, often base their decision on expectations of future events. If a country consistently maintains a high GDP growth rate, it can create an expectation of future currency appreciation. This expectation can prompt investors to buy the domestic currency in anticipation of future gains. The influx of investors seeking to capitalize on anticipated currency appreciation usually drive up demand for the currency in the short term, contributing to its strength, a case in which you'll see investors remaining or traders and speculators remaining bullish or buying the currency as it continues to strengthen, which makes it even more stronger. However, if the actual economic performance deviates from these expectations, it can lead to rapid changes in the currency value, which calls traders who are observant to begin shorting or selling the value, accelerating its depreciation or the fall in price. Finally, we look at the political stability as affected by GDP. A strong GDP growth rate can reflect a stable political environment and effective governance. Political stability is an attractive feature for foreign investors as it suggests a reduced risk of abrupt political changes, social unrest, or economic upheaval. Foreign direct investment (FDI) and portfolio investment tend to flow into politically stable countries. Typically, as foreign investors commit funds to these countries, they usually convert their currencies into a local currency. The result increases in demand for the domestic currency, leading to its appreciation. However, political stability is just one of the many aspects, and economic fundamentals and global events can also influence the value of a given currency. It's worth noting that even as we conclude, while the positive relationship between GDP growth and currency value is possible in the long term, short-term fluctuations are common due to various factors. For instance, sudden shifts in economic data, geopolitical events, or global economic conditions can lead to short-term deviations from the expected relationship. The relationship between GDP and currency value is a versatile one that involves a delicate balance of domestic and international factors, as we have seen. As such, it is important if you are a trader to keep an eye or to have a clear perspective on both the GDP, the currency value, and any other factors that might influence its movement apart from just the GDP numbers or GDP data release. Thank you for watching, and remember to subscribe, and as usual, we will meet in our next video.